Let me start by saying I'm not going to tell you how to invest. Any experienced advisor will tell you what to invest in is always personal. It's about your goals and what you want. To invest is to save money or purchase a thing that potentially earns more money in the future. With investing comes risks and the risk of losing money. Most folks who invest hedge their investments with a diverse portfolio of assets, so when one share of stock in a company falls, other investments in other companies or assets like bonds mitigate that risk. Because of the risk of investing, many people start with mutual funds for their first investments. Mutual funds are investment funds of pooled money toward a professionally maintained fund of diverse assets. Instead of one share of stock for one company, you invest your money in a mutual fund which uses your money to invest in shares of stocks in multiple companies or assets and spread the risk on a diverse collection of assets. Let's discuss some important terminology and factors to look when assessing whether to choose an investment fund. There are two types of mutual funds, active and passive. Active funds have active managers, professionals who manage a mutual fund. An active manager tries to earn a higher return for investors through active research and investing. Passive funds have passive or less active managers. Generally, this refers to an index fund. An index fund manager strategy is to track an index, like the S&P 500, the Dow Jones. For instance, the total market stock index fund. Invest in shares of stocks for companies within the S&P, the Standard & Poor's 500, and that's it. When researching an active mutual fund, check for factors such as an investor's history over time, their experience in research, and expense ratio, or what their commission will be. The expense ratio's percentage will be how much is paid for administration and stewardship. Using Morningstar, available with your library card, you can type in the name of any fund recommended to you and begin researching that fund's performance history, fact sheets, and prospecti, or for some funds, actual analysis from Morningstar's experts. What should you look out for? Here are some suggested factors. Expense ratio serves as a big factor. No matter how well a mutual fund performs, if the expense ratio is too high, it could offset any returns. Ask yourself, is it worth the expense? Another factor that could cut into returns, load type. If you don't have a lot of initial capital, a back-end load charge for selling investments might serve best. A front-end load is charged when investing in a mutual fund. No load, no charge on sales or commission is typical for index funds or passive funds. It helps reduce cost overall. It's important to consider the asset allocation for a mutual fund and how it fits where you are. Some folks consider shares of stock to be a little riskier than bonds, so as you're nearing retirement, you may reconsider a mutual fund with less risky investments. You can also choose a target date fund based on what you conceive as your retirement date. These are frequently marketed as retirement mutual funds and will serve as a good component of your portfolio. They're going to change the asset allocation over time to reflect where you are nearing retirement. You can view these factors on both a fact sheet and a prospectus. Both provide similar information but differ in details. Fact sheets are brief, to the point, and serve as a tease of what a mutual fund offers. It's a good starting point for seeing factors. But a prospectus, while lengthy, provides more information, detailing strategy and investment goals. It can also provide vital details on historical performance and analysis. While a fact sheet can show charts and ideas over time, a prospectus may provide context of performance. Both a prospectus and a fact sheet are available from the mutual fund managers, the companies they work for, or on Morningstar.